Hey guys, welcome to Cult Research. We got something pretty interesting for you today, so make sure to stick around until the end of the video. And if you're watching this video at any point in time and you're like, hey, I like this guy, make sure to hit the like button and subscribe. It helps the channel out big time. I really appreciate it. So in the middle of the 2008 financial crisis, markets are tanking, banks are failing, people are losing their jobs left and right. Economic data was still showing that the economy was growing. I mean, Wall Street is literally on fire, and everybody's just walking around like nothing's going on. Sadly, this wasn't just a fluke. It's because of how we measure recessions in the US. And this is something that doesn't get a lot of attention, but it really should. There's a weird delay between when a recession actually begins and when it's officially called. It's one of those things that seems small, but it can have a huge impact on how we react, how markets move, and most importantly, how policymakers respond. Okay, so let's start with a really basic question. What is a recession? Well, if you took an economics class and remember anything from it, you'll probably define this as 2 straight quarters of negative GDP growth. And yeah, that's a pretty handy rule of thumb, but it's not actually how we define recessions in the US. The real definition comes from the National Bureau of Economic Research, or NBER, which sounds super official because it kind of is. They actually define a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. So yeah, GDP matters, but so does employment, income, industrial production, sales, so on and so forth. The key here is that the definition is broad and, most importantly, it looks backward. And just to clear up a common misconception, if we actually defined recessions purely by the 2 consecutive quarters rule, the US would have had somewhere around 30 recessions in the last 100 years. But the NBER has actually only declared 17 in the same time. That means that almost half of those hypothetical GDP-based recessions actually wouldn't have made the cut. The takeaway from it is that while it is a good rule of thumb, it misses some downturns and actually wrongly flags others. So within the NBER, who actually decides when we're in a recession? Well, that would be the NBER's business cycle dating community, which, if I'm being honest, it kind of sounds like a place that economists go to. It's a small group of economists, mostly from academia, and they don't really meet on a schedule like the Federal Reserve. They meet when they feel like the data demands it, and they don't rush it. In fact, they'll intentionally wait for revised complete data to make a decision. That means that by the time they say, yep, we're in a recession, we've actually probably already been in it for months. And we're going to talk about that a little more. Now, if you work in finance, or honestly, even if you just invest in the stock market, this is one of those moments where knowing how the system works might actually give you an edge. Because by the time the public hears the word recession, markets have probably already priced it in. But if you understand the delay and you're able to spot some of the leading factors, you might be able to tell when we're heading that way. So I kind of teased it at the beginning, but let's actually take a look at 2008 to get a better understanding of all this. During the height of the financial crisis, you might think that economic data was screaming recession, but that actually wasn't the case. In quarter 2 of 2008, the initial GDP report actually showed positive growth of 1.9%. Now that doesn't sound like a recession by either definition. Then came the second revision, which was released at the end of August of the same year. This nudged quarter 2 growth down to 1.8%, and in the next revision at the end of September, there was no change. But those steady headline numbers were masking growing cracks in other corners of the economy. GDP, especially in its early versions, it just wasn't picking up the full extent of the downturn that everybody else was already feeling. The underlying weaknesses in the US economy didn't show clearly until the quarter 3 data was released at the end of October of 2008. This finally showed a contraction of minus 0.3%. While this was the first time that GDP had printed negative, it was pretty modest by recession standards. By this time, markets were crashing, Lehman Brothers had already failed, and the Fed was slashing rates left and right. But we didn't get the word recession until the damage was already done. Now, this isn't just an old story or an outlier, it's a pattern. Understanding how slow the recognition process is can change the way that you read job reports, GDP estimates, even market swings. So why does this happen? Why does it take so long? Well, the short version is economic data isn't perfect. Take GDP. I talked about all those revisions just a minute ago. Those are actually the advance estimate, the second estimate, and the final estimate. Each version is based on more complete economic data, and the revisions can be pretty significant. Same thing with employment, income, sales data. The early numbers are often just kind of an educated guess. And the NBER, they don't care about being first. They care about being right. So a lot of times they'll wait. But to make things even worse, we're not just waiting on the NBER to call a recession before anything actually starts to happen. No, sadly, the last step of the NBER delay just starts us down a new cycle of lags that should, if implemented correctly, ultimately lead to a solution. So by the time the NBER officially declares a recession, we're now approaching the end of our recognition lag, which is the time it takes to even realize that there's a problem. Once we're through the recognition lag, we're on to the action lag, which is the time it takes for policymakers to actually decide what they're going to do about it. Finally, once we get through the action lag, we move on to the impact lag, which is the time between taking action and actually seeing any kind of results. Just because the Fed cuts rates or Congress passes a stimulus bill, doesn't mean that people are going to feel the effects overnight. These three lags together create a very frustrating reality. By the time we see data, pass policy, and start to feel anything, a ton of damage has already been done. So what can policymakers do about this? Well, it's usually too late to do anything preventative, but two things tend to happen pretty quickly once we get into that action lag phase. The first one is monetary policy. The Federal Reserve will start immediately slashing interest rates. In 2008, they cut rates from 5.25% at the end of 2007 to nearly 0% by the end of 2008. They might also launch quantitative easing, which is basically buying government bonds and mortgage-backed securities to pump money into the system. But beyond that, the Fed has a few more tools in its kit. First one being forward guidance. This is when the Fed signals its future policy intentions to influence market expectations and long-term interest rates. They might also institute discount window lending. This is when the Fed can encourage banks to borrow directly from the central bank to ease any short-term liquidity stress. In rare cases, the Fed will actually lower the reserve requirement, which is the amount of money banks have to hold in reserve, to increase the bank's ability to lend. Beyond that, the Fed may implement emergency lending facilities. One that you probably heard of in some variation was the Paycheck Protection Program Liquidity Facility, although you probably knew it as PPP loans. Now, it's not the same thing as a PPP loan that small businesses received, but PPP loans were distributed by banks to help small businesses cover payroll. The PPPLF was a way for those banks to then borrow money from the Fed using those PPP loans as collateral. It gave the banks the liquidity they needed to keep issuing those PPP loans without taking on too much balance sheet risk. Tools like this help stabilize credit markets, encourage lending, and keep the financial system functioning even during a severe downturn like we saw in 2008. So what about on the other side of things, fiscal policy? Well, during a recession, Congress tends to pass big spending bills. In 2009, we got the American Recovery and Reinvestment Act, which was about $787 billion. During the pandemic, we saw multiple relief packages totaling over $5 trillion. But then again, all of this happens kind of after the pain has already started, and all three lags are already in play. So why does any of this actually matter to you? Well, if you're waiting for an official recession announcement to adjust your financial strategy, you're already kind of behind the ball a little bit. Markets are forward looking, and by the time the news hits the public, Wall Street has usually moved on from it. The same goes for your personal finances. If you see layoffs ramping up, consumer spending slowing down, credit tightening, those should be some pretty big red flags to you. You don't need a press release from the NBER to start preparing. So to recap everything we talked about, a recession is not just two negative GDP quarters. It's a little bit more broad than that. Second, the NBER actually makes the call, but only after months of data revisions. This creates a lag between reality and recognition, and by the time policymakers act, we're usually knee-deep in a recession. All of this is a good reminder that staying informed allows you to be proactive instead of reactive. Learn to read the signs of recessions before the headlines catch up. Guys, if you found this video helpful or even remotely interesting, please hit that like button and subscribe for more videos like this. I post a new video every weekday, keeping you up to date on everything happening in the world of finance. Thanks for watching, and until next time, have a good one.